So liquidity means where money is, okay? Wherever there is money, wherever there is money, wherever you see money, that means that is where liquidity is. As you can see, the market moves like, the market needs money to move. The market needs money to move. So look at this. So liquidity is an area where there are rejections, where the market is rejecting. So as you can see, if it came here, market didn't clear this place off, wanted to clear it off, but didn't clear it eventually. So, but later came back here to clear out this liquidity. There was a rejection here. That means that there is money here, and then market needs to clear out all these stuffs to be able to move properly. And then you need look at what happened there. Maybe cleared out all of this place. It had enough energy to eventually move downward. So market is liquidity. Likewise for the bullish, as you can see here too, it came to clear out all of this liquidity, clear this liquidity out, cleared out, and so wherever you see it doesn't mean, oh, don't get me wrong, it doesn't mean that wherever you see a market like this, it means that it's going to come and clear it and clear them up like that. No. Liquidity just means money, and most of the time market clears out liquidity. Market is always moving towards area of liquidity. So even if you see liquidity here and then you have been buying from here, you should know that probably here might be a first good place for you to want to close your trade, because as it's going towards liquidity area, you might want to reject from there, which it did for a while here before continuing. So you can decide to take partial and then lock your trade somewhere around there. Now let's talk about looking at our trade before I move on too far. Okay, so let's say that you took a trade from here. Inside that box, you took a trade and your trade is already going, and your trade has reached here. Your trade has reached, let's say, 20 pips already. It has reached. You entered from here. To this point, 36 pips or 30 pips already. All you can do is that you can just decide, since that's 30 pips already, you can just decide to lock your trade at this point. Locking it means that you set your stop loss at that point. Okay, you set your stop loss at that point. This stop loss or take profit. I think it's your stop loss that you set. No, you set your stop loss at that point. So what that means is that whenever the market comes back again to this point, that trade is already risky. That means that it's going to close your trade for you automatically. It's going to close it for you in profit. It's not going to come back to your stop loss again or anything. It's just going to close in profit. Okay, so that means that you just set your trade risk and let it run as long as it wants to go. Then it can go as far as possible. Now look at how it went. Let's say you were able to catch this entry. Now see how far it was able to go. This is 359 pips, 380 pips from here. 380 pips from here, from that point. So it's going to be 380 pips here from that point, and then it did more than that. Actually, see how far it went. Oh my God, it went very far. It went very well. So you can lock you can only lock your profit, your trade when it's in profit. You can't lock it in loss. Okay, you can only lock it in profit, or you take partial. Taking partial means that, let's say you're using a standard lot size, 1.0 lot size. When you click on one, when you go to you do as if you want to close your trade. I'm going to try and do a phone demonstration of what this thing I'm saying. Or just if you want to close your trade here, just the moment you try as if you want to close your trade, you go to that page and then reduce your lot size and use it to 0.50. That means that half of that trade is going to close. Then the remaining half is going to keep running. So that's how to take partial. Learn how to take partial, take profits. Pay yourself when you're in profit. Market is not promised for anybody. When you're in profit, don't be greedy to say you want to catch all the movement. Well, the moment your trade is risk-free and you're taking partial, you can let the rest run and then do all of that. But you need to learn to be conservative and not being greedy. So liquidity basically means area where there is money. Okay, it means area where there is money. Okay, now there are liquidity resting here. the liquidity resting here. So if whatever means the market breaks above all those points, that means it's coming to clear out all of this liquidity and then probably continue to an upward movement or then come to a downward movement. But whatever it is, market needs liquidity. As you can see, it cleared out liquidity here in this area, and then probably in the future might be coming back to this point. I won't be sure if markets come back to this point and continue buying. So I'm expecting market to sell to this point. That is my bias about the market.
Red and white.
Oh, sorry about that. I didn't know that people are being muted. Please mute yourself, guys. Thank you, guys. Thank you for that. Please mute yourself. Oh my God. I didn't know because I was already at least comes with my own sound. Okay. All right, guys. So that is that about that. So that is what liquidity basically is all about. It's where money is resting. So in our future conversation, I'm going to explain to you more of liquidity, how they work, and how to use them. Okay, guys. So let's go back to our business and then let's talk about other blocks. Yeah, other blocks. Now it's getting more intense. It's getting more intense now. I want us to talk about other blocks. What are other blocks? What are other blocks? Okay. What are other blocks? What are support and resistance? What are candlestick patterns? Now, let me quickly talk about candlestick patterns. There's a book that you can read about them on the Candlestick Bible. Okay, talk about liquidity. Then talk about candlestick patterns. Okay, candlestick patterns. Candlestick patterns. Now there are patterns that appears on charts that indicate that indicates some stuffs in the market. Oh, good, you have the book. You can send it to the group, please. You have the group, send it to the group so that we can share. But you can download it anyway. You can download it online. It's everywhere. The Candlestick Bible. What is the essence of Candlestick Bible? What are we doing? What do we do with there are some things that happens in the market, right? Okay, there's a way that the market reacts that gives us indications of the market, what the market is planning to do. Okay, what the market is planning to do. Now, whenever you see this is a doji, it indicates a rejection, a change in pattern, that the market is about to change pattern, right? So now also you can see this rejection candlestick. This is a rejection, is a pin bar. Some people call it inverted hammer or whatever, but this is a pin bar. So this is one of the things you need to look out for. You're going to be using a lot of this in your trading life. It's something you should look out for very often. It's a pin bar, and as you can see, immediately the market is rejected. That way, markets are coming down, straight down. It doesn't mean that it happens all the time like that. Look at this one. It didn't start selling immediately. It went up again a bit, went up, first continue. But there are important things you need to look out for. But one of the most important patterns you are going to be needing in your journey as a trader is the engulfing candlesticks. Engulfing candlesticks. And then we have the bullish engulfing and then the bearish engulfing. Now, this is the bullish engulfing. Bull Remember I said that bull means buying, bear means coming down. Now look at this. Can you see how this long candle, the body and the wick, engulf the body and the wick of this red one? Okay, that's a long example. Now let's look for other examples. Let's look for other examples in the market. Okay. Now look at this. This is a bearish engulfing. This is a bearish engulfing candlestick here. A bearish engulfing candlestick here. Can you see it? Can you see? All you need is you need a body. As long as the body and the wick of the candle engulfs of this last candle, which is what you are seeing, the red one, engulfs just the body of the green one. It's an engulfing candlestick. Okay. Now let's look for more examples here. So this you need in your trading because they represent your order block. But I'm going to talk more on other block. They represent like your other block. As you can see here again, is a bearish engulfing candlestick. This is a bearish engulfing. The body and the wick of this candle is engulfing at least the body alone of this candle. Even though it's not, as you can see, it's not engulfing the top wick. You don't need the top wick. It's just for the other one, for the previous one, all you need is the body. The body, as long as the body and the wick of this one is engulfing just the body alone, it's another bearish candlestick. And here is a very good example of a bullish candlestick. As you can see, the body and the wick is engulfing just the body alone, even if it's just the body alone of this red candle. So you need to, these are the things you need to look out for, if whether in the middle or at the edge. This is an edge of the market. You need to understand these two words I just said now, edge and middle. As a good trader, you should learn to trade from the edge of the market and don't jump into the market in the middle. You can't be trading the market in the middle. You are not going to become profitable because you are not going to see or understand where exactly is the market going to. You're just going to be jumping into conclusions like some women do. Oh, I'm sorry, I said that about women. I'm sure some women jump into conclusion. Even some guys to jump into conclusion. People are always jumping, everybody's jumping. But so that you're not jumping into conclusion, you're not just jumping. Look at this engulfing candlestick here. The body and the wick engulf the body alone. This is a bullish engulfing. Engulfed it. Can you see after engulfing it, what happened? Market went up. It is bearish engulfing. Can you see the bearish, the red candle engulfed the green candle? Now, your assignment is to go and train your eyes to see it, identify them, circle them, screenshot them, and send it to my DM. And then for me to see them. Can you see? You have to identify, learn how to identify them. After the engulfing, what happened to the market? Drop. What engulfing means is that you find the engulfing at exhaustion, areas of exhaustion, at major zones and at areas of exhaustion. Before what you can see here before is bearish, bearish, bullish, bearish, up, bullish, small, then bearish, bearish. Can you see? Can you see? What you can see is what happened is this means that the market has been bearish for a while. The moment there is an engulfing, a candle that comes up again and engulf the last bearish candle, that means that the market is about to take a U-turn. It's about to change its direction from being bearish to bullish. And as you can see, it went bullish. Now look at this bearish engulfing. We have bullish, 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 bullish. Then we have a long one, long rejection, and then an engulfing. Then the last green candle. Now this is the last bullish candle movement. The moment a candle comes and come down and form and comes below and is longer than the previous one and engulfs it totally, as you can see, the wick of this one. Remember I said the present candle or the last candle, the wick must be longer and the body must be bigger than just the body of the previous one. So what we need here is just the body. So as long as it's longer, can you see the way it's longer? Market. So market, that means that there is exhaustion. The buyers are already exhausted in the market, and then the sellers are about to take control. In the forex market, there's always a battle of the buyers and the seller trying to take control of the market. So whenever you see a red candle, that means that there's a presence of the buyers in the market. The sellers are about to take over. They are looking for ways to take over. They are fighting their way through. They are pumping. They are trying to sell the market against the buyers. When you want to see a bull candle, that means the buyers are trying to take over the market. They are trying to, buy their way into the market. And as you can see, the way the market kept, coming down after the engulfing kept coming down. It doesn't mean that it's going to keep happening everywhere, every time, because you can go and be seeing them at the center of your chart. That is why I said don't trade, you don't look for stocks at the center of your, don't trade from the center, trade from the edge of the market. Now, this could have been, this is not really an edge, but on it is a 4 hour time frame, so it could be a major zone for us or smaller time frames, right? So what you need to look for is long candles and not too long, but bodies candle engulfing, each other, a smaller one, and wherever, and they are usually what you use to represent your other. As you can see, this long rejection. Somebody will have thought that the market is going to buy long immediately after that. Well, it sold it for a while before it bought a little, but didn't buy too much, and market came out. So it doesn't mean that your pin bar works all the time, depending on where is the pin bar happening from. Is the pin bar happening in the middle of the market of the trade, or happening at the edge? As you can see, this one is happening in the middle of your trade. This is the middle of your trade. This is the edge. If you have seen it here, it could have worked. Now, the one that we saw here, see the way it worked. Market started selling them properly. And look at this one that was rejecting from up here, because it was at the middle of the market. Okay, just broke few lows and all that, was in the middle of the market, right? So it didn't look right. Okay, now look at this one that was at the edge of the market. It was at an edge. Means the origin of a zone of where a movement is happening. Can you see the way markets drop from here and drop and drop and drop and drop and drop? Okay, so let's go back to what I was explaining. So other blocks is an engulfing pattern that you see in between your zones. Other blocks is an engulfing pattern that you see in between your zones. Okay, so anywhere that you see an engulfing pattern, that means that and you see them around zones or some important areas, you can use them as another block, Okay, and sometimes, let's take for instance, for your other block now, you can use, if you want to use it as another block, well, these two candles look like a tweezer, equal highs and equal lows, but the green candle with the wick is engulfing this. But if you don't feel satisfied, you can join and combine these two candles together to make it one, to make it an engulfing candlestick, to make it that, okay, this candle is engulfing this candle. You get what I'm saying? And then you can use them as important areas. Same for the bearish. You can see this small one. It looks, I don't know if you guys can see what I'm showing you. This small candle here looks like it's not engulfing enough. You can join these two candles together to make it a bearish engulfing pattern. And then you have your other blocks. Okay, other blocks like I mentioned, they are areas of orders. They are areas where we have orders, where others are waiting. Like I said, the way you have set your order, buy order, sell order, buy stop and sell stop, and you're waiting for market to get there, and then you enter your trade and all of that. That is how we have orders everywhere too. We have order block. There are areas where the important areas that market gets to and reacts to. There are areas whereby the institutional traders, those are the big guys, the banks, the institutional traders, the institution traders, the CBN. That is why they position themselves for trade. That is why where they accumulate their position or the positions themselves for trade. Okay, that such in case that if they are not there, that if because they don't execute their trade all at once, they set limits and then they put their money at the position. That is where they form the orders. So that when market comes to those positions in the future, market will activate those prices. So market activates them usually at an engulfing pattern area, or which is your order block. Okay, so your order block stands as a place where the market comes to pick up the money, to pick up the orders that are waiting there, so that it can move along with everybody. I don't know if you guys get what I'm trying to explain to you. So this is what you should understand about that block. We are going to do more of the advanced order block, and then we are going to do more of the advanced talking more about liquidity, but this is just an introduction into the traditional reference points where you into the traditional trading. But what I trade is I just trade what works. I don't have a name for it. It's a combination of so many things. BFI, you know, for my friend daily, for my guys, whatever I see people here and there, and then we learn them and trade together. And then, so you too need to come to a point where you grow a strategy for yourself. Your strategy is going to be a combination of different people's strategy, or your time that you are spending in the market, and how long of the time you have been spending in the market trying to understand the market. So I'm going to end the class here. So if you have any question, please go ahead and ask me.